Good day, fellow investors. Borat said, Sven, covered Dollar General. I had a few questions and I said, why not discuss it, see it, check something new and give you perhaps a perspective that is specific of my own, thus add value in some way, because I didn't read much about the company, haven't been following. All I know is that the stock is 52% down in less than a year. So let's look at what's going on. And immediately I want to give you something when it comes just to the stock performance. And you can see there has been a clear trend over the last decade or so. Here it went above trend as the pandemic and closure and everything was a great time for retailers. Maybe then here it was exuberant, and now it is just reverting to the base trend it had earlier. Of course, when things go bad, it very often happens that a stock is oversold because people panic, close the positions, automatic selling, stop losses, but for value investors, this is cheaper and cheaper, and therefore there might be an opportunity. Remember, market capitalization 27 billion, which will then be important for valuation. For now, over the last year, it has been nothing but down 52%, so let's see whether we are at an opportunity now. However, keep in mind that trend overshooting and undershooting the trend, the stock is where it was just a few years ago before the pandemic boom. Let me just take a quick look at the business, and it is, after all, retail. So Dollar General Corporation, chain of variety stores for $1, of course, and they already have 18,774 stores, and if you look at the investor page, the key there is growth. Growth, growth. Thus, this is a retailer aiming for growth, which then also explains the growth trend here and the higher valuation. Because we'll see later in the fundamentals, nothing much changed, but the P ratio here was 25 just a year ago, and now it is 12.5. But the business is still there, everything looks still like not going bankrupt. Therefore, this might be a P ratio of exuberance, and now it might be a little bit more fairly valued. What happened, especially in the last quarters? So net sales still increased 3.9%. Okay, that is below inflation over the last year, let's say, or around inflation. So real sales didn't move much. Same store sales decreased 1%. So that is a negative trend. From the growth, we are now to a small decrease. Inflation, higher input costs. If you sell always mostly for $1, then you get squeezed a little bit, so operating profit decreased, but is still 692 million. They have some debt, so that also squeezes the net profit margin, but earnings per share are still to $2, so they still made money despite the situation, and cash flow from operation also still there. So still cash flow positive, still making money, but the growth trend has stopped. And when that happens, there is a compression in valuation from growth stock to not growth stock, P ratio from 25 to 12, and you get a 50% decline. The question now is whether this is just temporary, whether it is fairly valued at the P ratio of 25 or at a P ratio of 12 or 10, which would then give an answer whether this is an opportunity or not. I then checked a little bit the guidance. They are still planning on doing 1,050 new store openings, so just 50, 60 less than previously. No share repurchases, so they are focusing on that, opening new stores, investing into the business a little bit less, but still 2 billion of capital investments. So that is something significant for a retailer, and they expect EPS 8% decline to flat. That will likely be even bigger. These estimations are always trying to look as positive as possible, but you never know, this could be a little bit lower. They are lowering, they might lower in same-store sales, net sales, below inflation, so macroeconomic headwinds, etc. But when it comes to a retail business, what's the moat? There is no moat, and therefore, if there is competition, if other retailers squeeze your margins, higher input prices, less purchasing power, keep in mind 2021, 2022, everyone had excess savings, especially in the US, to spend. Those excess savings have been spent, thus that exuberance in spending is gone. But let's look at the financials and see whether we can make a valuation. If I look at the revenues, so that is a clear growth story from 22 billion to 38 billion. So growth, and they will keep investing for that growth. However, keep in mind they are investing 2 billion per year, which is 7-8% of the market cap for growth, remodeling, and everything. Gross profit margins a little bit higher here, 2021, 2022, now a little bit lower, which leads to operating margins, especially now, last 12 months, a little bit lower. And retailing is a very, very thin margin business, so these changes have a big impact on the bottom line. Everything was great. It doubled net income till the end of fiscal 2023 in February, but now net income is down and we are around 2 billion. Okay, 2 billion, P ratio of 12.5 as we discussed earlier. If I look at the balance sheet, they made an acquisition a long time ago, so okay, there is 4 billion of goodwill, inventory 7 billion, they have a lot of investments, 30 billion of assets, long-term debt 7 billion. Okay, capital leases, that has to be included in the balance sheet since 2020. That is what they have to pay for all the leases they have on their stores, and there is significant liability. So they went from 3 billion to 7 billion. Shouldn't be much compared to the market cap and the possibilities and the 2 billion of cash flows, but keep in mind those costs of the leases are included in those calculations. So we can focus on this. Therefore, okay, manageable, and one, if it gets worse, activist investor or something could get his hands on it. When it comes to valuation, very simple. If they keep stable, 2 billion times 10, 20 billion valuation. If they continue to grow to 3 billion, P ratio 15-20, 40 billion valuation, that's 50% up. But always keep in mind Warren Buffett's words when it comes to retail. Retail is a widowmaker because it's a very, very hard business to be in, and we remember the Walmarts, etc., but we forget about all those that try to go into this business, try to grow, and then you never hear about them, and that is the risk and reward when it comes to Dollar General. So as I said, these chains usually come and go. If there is a recession, some people say, yes, people will shop there more because it's cheaper. No, simply everything goes down when there is a recession because of purchasing power going down. What is the moat? It could turn around, but also not. Warren Buffett doesn't have many retailers, and he's one of the persons that knows US retail the best. That is something to think about. Definitely, it is much better now than a year ago because there is still the business, still making money, all good. I'm looking at it and saying, okay, an activist investor could really shake some things up, make 50% or something, then sell it to someone. Perhaps at 27 billion market cap, it is too big of a bite for an activist investor. Perhaps at 20 It could be then doing something with it to get 30 out of it, could be something interesting, but that is something. Of course, an activist can take a 10% stake into it. You have to see that. But what are the projections? So we go from earnings of around $10. The consensus is that for this year it will be $7.75, so 25% down, in line with the last quarter, then a little bit stagnation, and then the projections is that earnings will almost triple in the coming 7-8 years. However, if you look at Wall Street, you have number of analysts at the beginning, let's say a dozen, 2,000, a dozen of them, and then just two, and then just one. So we can disregard all the projections going forward, and these projections have been positive like this before. So this is the difference that came because of the earnings. They are always too positive. But if the earnings stay flat, competition, moat, recession, whatever, or even go a little bit lower, higher interest cost, etc., then this can still look uglier if it happens. This is not a value investment because there is no margin of safety yet. Maybe at 20 billion with an activist investor you can get 40-50%, but then it is still a retail. You can only expand up to a point and then the growth simply stops. It's very hard, 1 in 100, to really just keep on doing what Walmart did, etc. So there is no margin of safety here. I think you can make some money if you want to open a small position now, then if it goes lower, buy more, then sell when some activist or something comes in, when some good news come in. But if a recession comes slowing down, then you will have to wait in the position for a long time. So I think that we are still all under the influence of the extreme 2 years of spending, where you would get checks in the mail for doing nothing, and the trend is simply reverting to the normal, and it might go a little bit lower until these excesses get cleaned by the system. So not for me. I'm not going to follow. I hope you enjoyed just my opinion. That's it, my opinion, and you got some value. See how it fits you. Thanks for watching. I'll see you in the next video about high dividend yield stocks, strategies, preferred, etc. Thanks for watching.